This is Wall Street Week, bringing you a special edition on what the new Trump administration could mean for global Wall Street. Coming to you from the Cornell Tech campus on Roosevelt Island. I'm David Westin. Growth was a recurrent theme for Donald Trump in running for president this time. Growth in the economy, growth in employment, and growth in the stock market. His pick for Treasury Secretary, Scott Bessent, laid out for us at least part of his plan to get there.
I'm a big believer that for Trump 2.0, that we can control spending by freezing the discretionary component except for defense and moving toward a 3% deficit by 2028. I think that would be music to the market's ears. I think the debt market would respond to that. I think rates would go down. I think inflation would go down. So there's a chance here for a self-reinforcing cycle.
To take us through how Wall Street looks at what Trump policies could mean for that growth, we welcome back now Rick Rieder, BlackRock Global CIO of Fixed Income and head of its Global Allocation Investment Team. Rick, great to have you back.
Thanks for having me.
So I think it's your ears that Mr. Bessent was trying to appeal to. Is he right that if he could bring that off, it would be music to your ears? And is it doable?
So I don't know about music. It's more of a symphony. I mean, it can't be any better. I mean, what the markets care about is there a plan? And I thought one of the key things we said by 2028, there's a plan in place. Oftentimes you have elected officials like, we're going to spend and we're going to do it now. It has to be a progression, but it has to be a thoughtful progression around how do we get spending down, but we don't do it to really disrupt the system, but there are thoughtful ways to get there. And my sense is there's a series of initiatives they're thinking about how to get it down, how to restrain spending, and then come up with a consistent plan. Listen, the debt is the biggest problem. The U.S. economy is in incredible shape. I mean, the vibrance of this economy blows people away. I mean, how many times last year we had a recession? The economy just moves along. There's one risk that's out there, and that is the debt burden. If we have a plan to bring it down, markets are all about confidence, and confidence that we see the plan, we see the balance, we see how we can create equilibrium over time, and that can't be any better.
So it's a tall order, I think everyone would agree to, even as we say we'd love to have it. But right now we have above-trend growth. Can we sustain that over the next 2, 3, 4 years?
So I think the harder one is, can you do it without any price pressure? So the U.S. economy, you think about, I was looking at, almost every single month for the last year, almost the last couple of years, income growth. If you take the payroll and you look at where income is, it's 5% almost every single month. It's amazingly stable. So can we still run at 2, 3% real GDP? If you see some initiatives around deregulation, if you see some initiatives that are incentivize people to invest both globally into the U.S. and domestically, you can still grow.
So economists tell us that there's a potential for the economy, and it's largely a function of how many workers you've got and how much productivity you have for those workers. Right now we're talking about, if anything, potentially having fewer workers, the demographics, but also on immigration. So can productivity really kick up that much?
So first of all, I would argue that the best indicator of growth over the intermediate term is demographics. When you track what GDP does, it's amazingly sympathetic to the demographics, including, like you said, immigration, et cetera, the age dynamics in the country. But that's over the intermediate term. You can come off that demographic curve because of stimulus one way or the other. So think about what's going on. So will you have some modest reversal in immigration? Probably. But I don't think it'll be significant in terms of aggregate demand. And it really can't. And I can't believe the president will want. There's some real initiatives they're trying to solve for. But I don't think there's going to be a mass deportation of people. So I don't think that is going to be that significant. What I am energized about is I think people think it's going to take longer. I think productivity, everybody talks about AI, but software, inventory management, logistics, technology is changing. People talk about the high profile things like we're going to have driverless cars. But I don't think people talk about other ways that we do business, and even in our business, how we think about documentation, how we think about how we create HR, human resource reviews and things. Like, all of a sudden, we're implementing a whole series of things. We're going to hit an inflection point on inflation, and it's hard to say is that 6 months from now or a year and a half from now. But productivity is going to be the vehicle we're going to drive on to get there.
What does this mean for rates? What do you anticipate, given everything that Donald Trump is likely to do?
So I think there's a near term and there's a longer term. So I think the near term is, listen, I don't think the Federal Reserve can cut rates anytime soon. Maybe the back half of this year. We've got to see, because you've got this growth, I think this growth stimulus that's in there, and you've got what is, nominal GDP that could run at about 5%. Pretty hard for them to cut rates. And they did, which I would argue was a great call, to get rates down to a level that's not that restrictive and just leave it there for a long time. So usually it takes the Fed moving to get rates down. So I don't think rates are going anywhere anytime soon. I certainly don't think they're going down. The other side of it is it's hard in the near term to get inflation down. So with all these initiatives, including, there is a near-term effect. I don't think it's a long-term effect around tariff. That is a price level adjustment. But in the near term, that does affect it. Some deglobalization, because you're going to have some build in the U.S. as we bring some of the manufacturing and other product back. So near term, I think inflation stays a bit higher. So what does that mean? Listen, I don't think anybody's going to make any money on interest rates rallying anytime soon. If anything, I could see them migrate a bit higher in the near term. But I think what's going to happen is you're going to have this in the near term, and then I think we're going to hit this inflection point alongside the productivity enhancement that I think will be quite real. But in the interim, I like staying shorter in terms of my interest rate exposure. And by the way, it's a pretty historic point in time with interest rates where they are, and the yield curve as flat as it is. You can sit in the very front end of the yield curve, clip a lot of coupon, a lot of income. We run this ETF, and they go BINC, that we just clip coupon and income, and you don't have to. Traditionally, as a lender, you have to go way out. You have to lend long. You don't have to do that today.
How different may this Trump administration be than what we've seen in the past? A lot of things you describe have been around for a long time. Things like the debt and deficit you think are so big. Nobody's been able to fix it. Can we really expect them to find new approaches? And let me introduce, for example, Elon Musk. What's the Musk effect in all this, in sort of different sorts of thinking?
So I'm hoping, that, listen, I think the way traditional economics work, the traditional how we thought about tariffs, how we thought about some of these initiatives, I actually think there's going to be some vibrant thinking, some new thinking that are being, if you think about what tariffs are, do you get an initial price level adjustment? But you can actually create growth around it. If you're going to see more product produced domestically, there are certain products that are efficient for us to continue to export. How you utilize tariffs can, quite frankly, not be that. People say the normal traditional economic thesis is, lift inflation and then it'll slow growth. I'm actually not sure. And I think a lot of, in the type of economy we operate in today, service economy, different than the past. I think the historic algorithms of how you thought about how economies respond. Think about interest rates. We talk all the time. People say, oh my God, rates are going high, the economy's going to tank. It doesn't happen. I think you'll see some innovation in this administration, and I think you'll see some things that are different. And I think they're going to, quite frankly, try some things and and determine, where is, and I'm hoping, quite frankly, some of these initiatives, as we talked about earlier, have a longer-term perspective to them, like not just focus on the next week, the next month, but how do you put in place some initiatives that are creative, thoughtful, and create what I call velocity, that are durable and actually put the economy on a pretty good spot longer term versus, gosh, we got to succeed in the next month or so.
We've spent several years now fixated on the Fed, what it's going to do, what it has done. Every month we talk with you about exactly what's going on. Are we looking at a time that actually the Fed may be a little less relevant? That will we focus more on the White House and to some extent Congress, a little bit less on what the FOMC does?
So David, we've lived in the markets for a decade or more in this dynamic of everything's on the back of the monetary policy mechanism, not just in the U.S., in Europe, Bank of Japan, Bank of England. And it has been because normally, for years we've thought about the way policy should work is monetary fiscal policy work hand in glove. Fiscal creates some initiative on the to stimulate, and then the central bank pulls back, and then vice versa, and you get this pendulum effect. We've lived in a world where there's been functionally no effective fiscal, and it's all been on the back of monetary policy, and way too much. Today, I actually think central bank, the Fed, should go on holiday for a while and let the fiscal do what it's going to do, and then react. If inflation is a bit higher, then maybe you have to react that. If, in fact, we're getting productivity, then you come in and look at that. I think today it'd be great to have a different decade than we just had, of where it just had to be the monetary policy tool, and it doesn't work. Think about negative interest rates in Europe. It didn't do anything other than hurt the banking system, the pension system. It doesn't work. Extremes of central bank policy do not work. So I think the extent that you have some fiscal, it's quite healthy.
Many thanks to Rick Rieder of BlackRock. Coming up, we continue our special edition anticipating what lies ahead during President Trump's second term, focusing on fiscal policy with Torsten Slok of Apollo and MacGuineas of the Committee for a Responsible Federal Budget, here on Wall Street Week. This is a special edition of Wall Street Week focused on what President Trump's return to the White House will mean for investors. I'm David Westin. President Trump returns to office having committed his administration to cutting two things: taxes and the cost of government. Mitch Daniels ran the OMB for President George W. Bush before becoming governor of Indiana and head of Purdue University. And he says cutting the cost of government is long overdue.
It's not a bad place to start. You're right that the money's not as big, but for the reasons we've discussed, I think it is a more straightforward case to make that the federal government needn't be doing many of these things. And we're going to have to get into a mode where the federal government limits itself to must-do items, nice-to-do items or optional ones. We simply can't afford anymore. We haven't really afforded them for quite a long time. As I've sometimes glibly said, you'd be amazed how much government you'd never miss. You would not miss. You'd hear the screams of the clients and recipients of the money, but the average person would not see any difference in their lives, and that might embolden the country to support other trimming and reductions and modernizations of the kind we really need.
That was Mitch Daniels explaining why we might not miss the Department of Education if it went away. To take us through the income statement and balance sheet of the federal government, we turn now to Torsten Slok, Apollo chief economist, and MacGuineas, president of the Committee for a Responsible Federal Budget. So welcome to Wall Street Week. Good to have you here. Maya, let me start with you. Before we get to what we can do about cutting costs and fixing the deficit problem we have, how big a problem is it? How do we define it?
It's big. It's big. So we've waited till the last minute to start to try to turn this ship around. We should have done this years ago. Debt to GDP, which is probably the most important metric, right now is about 100% of GDP. The record we ever had in this country right after World War II was 106. We'll surpass that in 2 years. That was right after a world war. This is during a time of economic growth and stability. More worrying, I think, is interest payments on the debt, which really signal the health of the fiscal situation. But they're the fastest growing part of the budget. They are the second largest item in the budget, larger even than spending on defense. And all these numbers are projected to get worse over time, with our borrowing about $22 trillion over the next decade if we don't do anything to make the situation worse, which, if you know Congress, I wouldn't bet on. So the fiscal situation is now at the point where it's having profoundly negative effects throughout both our economy and I would even say our national security. We've got to make changes really quickly at this point.
So, Torsten, as Maya says, the problem is bad and it's getting worse. Now, President Trump assures us he's going to somehow address it. But how do we see the problem in our everyday life, in the markets, in the value of assets?
Well, one thing that has been unusual in the last few months is that normally when the Federal Reserve lowers interest rates, you begin to also see long-term interest rates come down. But since the Fed started lowering interest rates on September the 18th last year, we have seen short-term interest rates have come down, of course, around 100 basis points, but long-term interest rates have gone up 100 basis points. And this has opened a conversation in markets about why are long-term interest rates going up when the Fed is cutting interest rates? And the worries and some of the debate is this because of fiscal worries? Is this because of other factors? And some of the quantifications suggest that maybe there is, at least in some of the term premium estimates from the Federal Reserve Bank of New York, there is some reasons to worry about that maybe as much as 80% of the rise in long-term interest rates has been driven by not what the Fed expectations have been doing, but by other factors, including, of course, what the fiscal outlook is at the moment.
Maya, you've dealt with the federal budget and the deficit for a good long time now. We remember the so-called bond vigilantes. What brings those out? Are we in danger at all of bringing out bond vigilantes?
Well, my highly non-scientific method would say things are changing. We're hearing from market people all the time. While this issue was kind of in the wilderness for a long time there, even when our debt was growing, even when we were clearly borrowing beyond our means and we didn't need to, interest rates were incredibly low. Markets weren't worried. Now they seem to be very worried, and we're hearing about it. We're interacting with them much more in terms of the policy level. The problem is, the sense I get is that markets want lower debt and lower taxes. Citizens want lower debt, they like that talking point, lower taxes, and higher spending. Politicians don't want to do anything hard. So you can see that there's a real understanding that we need to make changes, but the political will to get us there is really challenging at this time, because those changes, we can cut a lot that people wouldn't notice, like Governor Daniels said, but if we're going to actually make a difference, this is going to start to have real effects in some of these bigger programs that politicians have said they're not willing to touch. So we're going to have a political tension about whether we're going to do this for real or not.
That political will is almost always an issue in Washington.
Yeah.
But let's just
Bond
put that
vigilantes
aside.
help, though.
Well, let's put that to the side. If we wanted to fix the problem, what are the things that would make the biggest difference? There are a lot of things we could do, but where would we get the most bang for the buck?
Yeah, the three things that people have said they absolutely will not do is what we should really start with. So the biggest items are Social Security and Medicare, both of which are the largest government programs and have trust funds which are headed towards insolvency. So not only for the fiscal situation do we need to make changes, but if we do not take Social Security, in about a decade, it will be insolvent and there will be across-the-board benefit cuts for the people who depend on the program. So political points are scored for people who promise not to touch it. It really leaves everybody vulnerable, and it harms the budget because we're repaying trillions of dollars to those trust funds every year with no plan to make it structurally sound. At the same time, the promise, the belief we can do this without raising revenue is completely at odds with the general size of the problem. So I would start by looking at Social Security, raising the retirement age, thinking about means testing, changing the way you calculate inflation. Medicare, there are a lot of changes that we can make because the healthcare industry itself is remarkably inefficient. And finally, there's almost $2 trillion in tax expenditures a year, lost revenue from exclusions, exemptions, deductions. They are inefficient, they are regressive, they are not transparent. They pay us to do things we would do anyhow. So those are the three areas I would start.
Torsten, help me understand, when we talk about things like Medicare and we talk about Social Security, we've heard about it for a long time. Does that factor into the term premium you talked about as the term premium goes up? Are the markets really anticipating that as well as the sort of how much money we're spending week by week?
I do think that they do, because the market is looking at the Congressional Budget Office forecast and also MIAS and Committee for Responsible Federal Budget forecast, and they are all showing that we're going from 100% debt to GDP to 200% debt to GDP. And the biggest component of that increase is indeed mandatory spending, meaning Social Security and Medicare and Medicaid. And if you think about that, there's about 73 million people in the US who get Social Security and supplemental income from the government. That's a lot of voters, that's a lot of people. Mm-hmm. And if you begin to think about what the path looks like for demographics going forward, it is the case that this is by far the most important driver of why debt levels are going up. So that's why, from a market perspective, it becomes, in some sense, it doesn't matter for the market where the cuts or how we're going to reverse the trend, as long as auction sizes do not grow dramatically, as long as treasury auctions and the metrics coming out of how treasury debt is auctioned begin to potentially look better, at least down the road. Because it is clear, as Jay Powell also has said numerous times, we are on a sustainable path at the moment.
Maya, we have now a president coming into office who says that he really wants to do something about the deficit. Now, to be sure, it seems to be on the cost side, not on the revenue side. But let's assume he does have the political will. He has two people who's going to help him on that, Mr. Musk and Mr. Ramaswamy. How difficult will it be to really make a substantial reduction in the deficit through cost cuts?
If they are not concerned about politics, we can get a lot done. I think the real challenge is going to be what they recommend, where I think they'll have very sound and probably aggressive recommendations with what the president and Congress is willing to do. But if they want to be serious about this, again, they would not take Social Security and Medicare off the table. But there are so many areas where we can change the way the government does its business, starting in healthcare reform. So looking at the hospitals, looking at the various associations, prescription drugs, the insurers. Tons of money to be saved there if we redo the way the entire industry is set up right now, where there's many inefficiencies. Likewise, procurement in the national security field, huge savings can be had there. But these are very vested interests. They're incredibly powerful. And like you were just saying, there are going to be more and more seniors who are voting. The AARP is also going to push back on them if they do go into that area where they should. So I think they'll come up with real savings. I think their disruptive approach is exactly what's needed. I worry that they have conflicts with the government and that we're going to have a lot of transparency around this effort. But I think they can come up with not that $2 trillion in a year that they originally were talking about, but they've backed that to about $1 trillion or less. That's very aggressive and reasonable at the same time. But it's once it goes into the political process where I think we're going to see pushback, because there are constituencies for every single program in the budget. I hope they succeed.
What about cutting the federal payroll? That's something that's been put out there. Actually, is something that would really help us.
Absolutely. We should do that. If you talk to anybody who works in government, the bureaucracy is bloated. There are certainly savings to be had there. It's not going to save a tremendous amount of money, though. One of the things that we've heard out of the DOGE folks so far is pointing to the things where the savings seems kind of easy, like let's cut the huge bureaucracy, let's save money on the silly stuff like gerbil racing, and all the laugh lines out there. Those aren't where the dollars are. The dollars are in interest these days, but the things that you can control: Social Security, Medicare, Medicaid, and National Security, where there's a lot of savings. But I would say those savings are going to end up being plowed back into that area of the budget, what I think is very likely to grow. And we probably have to think about that too. National security and climate-related disasters are likely to absorb more and more of our resources going forward, which puts on an even bigger squeeze than we already have.
Torsten, how worried should we be about this? Because there are members of your profession, economists, who say, as long as we have the reserve currency, you don't really have to worry about it that much. We can continue to borrow going forward. How should we be worried about this? Are there consequences that could really hurt our economy?
Well, the good news is that the rest of the world is not in good shape when it comes to this discussion, both when it comes to the fiscal outlook, but also when it comes to the business cycle. Europe, from a business cycle perspective, is not doing very well. UK is not doing very well. China is not doing very well. Japan is doing a little bit better. But for global investors, they still want to invest in U.S. financial markets. It is the biggest financial markets, both on the debt and the equity side. So that is, to a large degree, helping us a lot at the moment, and a very important reason why the dollar is going up.
Are we going to get it done?
Oh, no. We're not going to get enough of it done. I mean, right now, you would need to save $9 trillion over 10 years just to stabilize the debt as a share of GDP where it currently is. You'd need $17 trillion to balance the budget. That's not happening. Luckily, we don't have to balance the budget, but what's discouraging is that a decade ago, that was the goal, and it was a reasonable goal. Now it's not. $9 trillion in savings is a tremendous amount. When we put in place the Fiscal Responsibility Act as part of the debt ceiling last time around, that saved $1 to $2 trillion. That was difficult to do, and that was the easiest part of the budget, discretionary. So now we're moving into savings that are going to have to come from the harder parts.
Many thanks to Maya MacGuineas of the Committee for a Responsible Federal Budget and to Torsten Slok of Apollo. One of the changes President Trump has promised is in the U.S. approach to trade and tariffs. To explain where we may be headed, we're going to talk with Ambassador Michael Froman of the Council on Foreign Relations and Libby Cantrill from PIMCO. That's next on our special Trump administration edition of Wall Street Week.
Every economist I know who's not employed by a labor union is in favor of free trade. Every congressman I know is advocating some restrictions on trade. Can we survive without putting new restrictions on trade?
Well, I don't think we have to put new restrictions on trade, but we sure got to get a better deal out there. We are absolutely the world's worst negotiators on trade.
That was Louis Ruckhiser on Wall Street Week talking with GM CEO Roger Smith back in 1987, back when free trade was still in fashion, and before Michael Moore made Mr. Smith the centerpiece of his mockumentary, Roger and Me. As we anticipate what the second Trump administration may mean for investors, we have to consider the pledges he has made to raise various tariffs on trade with others. Here to sort it out, we turn to Ambassador Michael Froman, President of the Council on Foreign Relations, and Libby Cantrill, Head of U.S. Public Policy for PIMCO. So welcome, both of you. It's great to have you here. So first of all, start with exactly what the Trump administration did the first time in 2017. What actually happened?
Yeah, so what we saw them do is move forward with tariffs, limited tariffs on limited products from China. On average, the effective tariff rate increased from about 2% to about 12% on Chinese products. But it was still limited. And it was sequenced. It had exceptions. So it was quite different from what he has indicated that he wants to do under Trump 2.0.
So it was limited, Michael, but did it have effects on the economy? Did it affect the stock market? Did it affect values?
I don't think it affected the stock market because the stock market took a lot of other things into consideration, including tax policy, deregulation, and other issues. It didn't necessarily have the effect that was desired, though, in that, for example, steel, he put tariffs on steel, not just coming from China, but from around the world. And we didn't see that much more steel production or that much more steel employment in the United States than we had before. What it ends up doing is diverting trade. So rather than importing from China, we're importing less from China and importing more from Vietnam, from Mexico. Mexico is now our #1 trading partner. And we're still importing, though, more or less the same amount.
Yeah, but President Trump has a solution to the Mexico problem, right?
More tariffs.
He's going to go after Canada and Mexico,
more
right?
Tariffs on everybody. Look, I think he starts from the premise, and this is a core belief of President Trump. He's been focused on tariffs for decades. He starts with the premise that bilateral trade deficits are bad. It's a measure of who's winning and who's losing in a relationship, and the tariffs are intended to set the standard that we want to eliminate bilateral trade deficits, either by those countries buying more of our goods or those countries selling less of their goods to us, and that it's beginning of a negotiation. Now he's also said tariffs are a very useful tool for a lot of non-economic issues, whether it's migration or fentanyl or to deter countries from invading one another. So it's become a tool of choice for the incoming administration.
How much can President Trump as president do without Congress, Libby?
Michael knows this well. I mean, he can do a lot. The Congress has bequeathed a lot of authorities to the executive branch, meaning that much of what he has threatened to do, whether that is just empty threats, whether that's just bark and not bite, he could actually do, and he could do it without Congress. So, for instance, he can increase tariffs on China. He can potentially declare a national emergency and put a universal tariff on under powers that are afforded to him by IEEPA, a very kind of esoteric statute that is not typically used. And then there are other statutory authorities that were provided by the Congress to the executive branch dating back into the 1930s. And we actually haven't seen use of those since the 1930s. But again, I think the punchline for investors here is that mostly on fiscal issues, on taxes and spending, you have to go through Congress. But in terms of tariffs, the executive branch and the president specifically can do a lot and basically can do it unchecked.
Michael, why did Congress cede so much authority to presidents through the years? How did we get here?
I'm not sure they realized how much authority they ceded. And in fact, there's a debate going on in Congress because they read the Constitution as giving them authority to regulate interstate trade. And trade policy by custom has always been a partnership between the executive and Congress. But as Libby said, between the various trade laws, but also IEEPA, the International Economic Emergency Powers Act, if he chooses to invoke it, he has really pretty much unchecked power. It may be questioned in courts, but my guess is there'll be a fair amount of deference to the executive.
You mentioned that Donald Trump indicates that he may use these for purposes other than purely economic purposes. All sorts of political issues might be. How effective is that? I mean, some people say he doesn't really want to impose the tariffs. He just wants to use it as a bargaining chip, if I can put it.
That's right. Look, I think we have to, first of all, take him at his word and take what he says seriously, because he does have a very strong belief in this area. But he does love to negotiate the deal, as we all know, and he wants to negotiate from a position of strength. And thus far, he's been really quite successful in that when he announced that he was going to impose tariffs on Canada, Canada immediately upped their budget for border security. And my guess is that they announced the tariffs on Mexico will lead to a conversation with the government of Mexico about what more they can do on migration and on fentanyl issues. And really country by country, my guess is tariffs are intended first and foremost to bring the other country to the table. And then if they can't reach an adequate agreement on the outstanding issues, he may ultimately impose them.
Donald Trump seems to think they're also there to raise revenue. He has said that he thinks he can replace a lot of the Internal Revenue Code essentially with tariffs. How big are tariffs? Can they really make up a lot?
Yeah, so this is actually something I do think that's quite important. I think the market just views tariffs as a problem, but I think in a lot of ways, President Trump views tariffs as partly a solution. Not only to get concessions from our trading partners and maybe to kind of right a wrong, but also to raise revenue. And if you look at actually current customs revenue, the U.S. is generating about $100 billion of revenue a year from existing tariffs. So it could go up much more. Now, of course, tariffs could have an inflationary and could impact growth as well. So it does have sort of a double-sided effect, and that could actually affect revenues just generally. But if you just look at it sort of steady state, tariffs, they're basically a tax, and they can increase revenue quite a bit. And this is actually, I think, on the Hill, something that's pretty salient because, they are looking at this as a potentially relatively big source of revenue.
Does that make extension of the Trump TCJA, right?
Yeah, the Tax Cuts and Jobs Act.
Does it make it easier to get that extension done?
I think that it sort of depends on whether the CBO, the Congressional Budget Office, incorporates that in the overall score. And as you know, members of Congress are really focused on the cost of the bill with the score of the bill, according to the CBO. But I do think it's going to be in the back of the minds, even if it's not legislated so it can't be scored by the CBO. I do think it'll be in the back of the minds of members of Congress when they go vote for a big tax cut bill that will likely add to the deficit. I think in the back of their minds, they'll think, well, will be increasing some revenue.
I think there's some irony there, though, because either tariffs work, in which case you're going to reduce imports and therefore have no tariffs to pay, or they don't really work and they're going to increase the cost of goods that consumers and manufacturers that import inputs into their manufacturing processes have to pay. And so, I think it's of limited use really as a revenue tool. I mean, even the $100 billion, when you have a Trump tax cut, which might cost $5 trillion over 10 years, tariffs are not a substitute for income tax, either corporate or individual income tax.
But it may get the other side to the table, but you might not like what the other side has to say. There is retaliation that could be in there.
When we look at the cost of tariffs, we tend to look just at the direct cost of tariffs. How much more a consumer or an importing manufacturer might have to pay for their products. There's the cost of retaliation, and as you said, countries don't tend to just sit back and let countries impose tariffs on them without responding with an equivalent amount of retaliation. And then I think there's a third cost, which is the cost of imitation, which is that other countries around the world look and say, well, gee, if the U.S. can invoke the national security exception and impose tariffs on anything they want, why don't we?
Libby, at another time, in another place, Congress might get really upset about retaliation and trade wars and things like that. How much of this is really filtered through the China lens, if I can call it that really changes the entire dynamic on Capitol Hill?
I think a lot is. Honestly, if you ask the average member of Congress back in 2017 about tariffs, I would say, 90% of members would say this is a bad thing. This is going to hurt inflation, will hurt growth, it will hurt our relationship with China. Now you fast forward to 2025, I'd say 90% of members will say that actually they're more supportive, particularly of tariffs on China. And because I think that they haven't really seen the economic impacts that are kind of the worst case scenarios that some of the folks have talked about in terms of kind of negative impacts from tariffs. So in some ways, I think that the proof has been in the pudding if you're a member of Congress, and that there hasn't been as much friction as I think was expected. And again, there's been this sort of upside on the revenue side. I think the fallacy, though, in that thinking potentially could be if there's a universal tariff. And while we didn't really see much of a pass-through from a CPI perspective on the first round of tariffs on China under Trump 1.0, if there's a sort of a universal tariff, meaning you really can't substitute goods, you don't have the currency offsetting effect, that actually could potentially be inflationary. And I do think that members of Congress may have a different view on that.
Michael, as a true international economics expert and in trade, explain FX and its function here, because why don't other people just devalue their currency? And that's not something President Trump particularly wants. He doesn't want a stronger dollar. That's not going to help his bilateral trade deficit.
No, and a lot of the policies that he is proposing could well lead to a stronger dollar, could lead to higher inflation here as well. And so we're going to see a lot of FX volatility potentially, depending on what actually gets announced and what gets implemented. The other thing I would say, to amplify what Libby said, is one thing that the tariffs on China did. First of all, it's tariffs on both strategic and non-strategic goods. Conceivably one can make a case that goods that we really want to see made in America, or that we don't want to be dependent on China for, we could impose tariffs on. There's a case to be made for that. Whether it should apply to T-shirts and footwear and sneakers, all of which are being bought predominantly, it's low-income Americans who spend a larger portion of their disposable income on imported goods like that. So it's a regressive tax on low-income Americans on a non-strategic set of goods, which we don't really care about whether we make T-shirts in America or pajamas in America. And I think the Biden administration kept the Trump tariffs on, despite a lot of efforts of people to say, why don't you separate strategic from non-strategic and at least relieve the tax burden of the non-strategic?
I was just going to go back to the FX point, which I do think that one of the reasons why you didn't see that consumer pass through was because the Chinese did actually devalue their currency, incrementally, and that actually absorbed some of the impact, some of the sort of a deleterious impact of those rounds of tariffs. I think the issue, kind of fast forward to 2025, is the Chinese currency is already very weak. They've already actually devalued it as they're trying to, revive their economy, and so their flexibility in terms of actually changing their currency is more limited. And as a result, if he does exactly what he said he's going to do, and I don't think any of us actually think he is, but I do think we should take him seriously for sure on this. This is a deeply ideological issue for the president. But I do think that you're not going to be able to kind of count on that currency kind of adjustment as a buffer, just given what's happening in China.
Many thanks to Michael Froman of the Council on Foreign Relations and Libby Cantrill from PIMCO. That does it for us here at Wall Street Week. I'm David Westin. This is Bloomberg. See you next week for more stories of capitalism.